Hello all of you. Today is day 5th and we will start with question number 7. Okay. So come to question number 7, which is on page number 12. SMM Limited has the following capital structure as on 31st of March 2017. Rupees in crores. Equity share capital, shares of rupees 10 each, 1200. Reserve, general reserve, 1080. Then securities premium, 400. Profit and loss, 200. Infrastructure development reserve, statutory reserve, 320, and loan funds. So loan funds, basically this is loan funds, okay, 3200 and 6000. The company is offered a buyback price of rupees 30 per equity share. You are required to calculate maximum permissible number of shares that can be bought back in both situations, and also required to pass journal entries. So here you can see that we have to first calculate the maximum number of shares that can be bought back in both the situations. So there are two situations here, situation 1 and situation 2. So we have to calculate the maximum number of shares. It means those three tests: resource test, share outstanding test, and debt equity ratio test. So we have to do the calculation under both the situation, and we have to calculate the maximum number of shares that they can do that can be bought back. Okay, and after that we have to pass journal entries. Okay, so there are two situations are here. All figures are same except this loan fund. Loan fund is debt. Here it is 3200, and in situation 2 it is 6000. Otherwise all figures are same under both the situation. 1200, 1080, 400, then 200, 320. Okay, so first we have to do calculation. Today is day 5th and question number 7, page number 12. Question number 7, page number 12. Question number 7, page number 12. Okay, now write down there determination of maximum number of shares that can be bought back as per the Companies Act 2013. Okay, Companies Act 2013. First test is resource test. So write down there resource test. So and give here write down rupees in crores. The figure which is given in question is in crores. So rupees in crores. So resource test first. So write down there what the rule here: maximum permitted limit 25% of paid up capital and free reserves. Okay, so there are two situations. So write down here situation 1 and situation 2. Only the answer will be differ in third situation, in debt equity ratio. Why? Under both the situation. Why? Because here the debt, this amount required in third test, that is debt equity ratio, and you can see that all other figures which will be required in resource test and share outstanding test, all the figures are same. So answer will be under both the situation will be same under resource test and share outstanding test. In case of debt equity ratio, the amount is differ here, 3300 and 3200 and 6000. So there will be difference in debt equity ratio, but it's okay, you can give the here situation 1 and situation 2. So write down your situation 1 and situation 2. Okay, one by one. So first, equity share capital is given 1200. So write down here equity share capital 1,200, 1,200. What we do then? We add free reserves. Add free reserves. Free reserves. Add free reserve. So here, general reserve is free reserve. Securities premium is free reserve. Basically, securities premium is not free reserve, but for this buyback purpose, we also cover what? Securities premium. Then profit and loss account and this infrastructure development reserve. You can see here in bracket statutory reserve. There are certain reserve which the company requires to maintain, mandatory by law. By law, they have to maintain it. We call it statutory reserve. So that is not free reserve. So it is not a free reserve. It is not a free reserve. Okay, it is not a free reserve. So when we calculate free reserve, we will consider general reserve, securities premium and profit and loss account. So we can do here calculation in bracket. You can just write down here 1080, then 400 and then 200. 400 and then 200. Do the total now. Total now. 1080, 400 plus 200. 1680. So 1680, 1680. The total of paid up capital and free reserve is 1200 plus 1680. That's come 2880. 2880. Okay. So 2880, 2880. Okay. Now this is the total paid up capital and free reserve. Free reserve. Now how much we are paying on one share at the time of buyback? We are doing buyback at rupees 30. We are doing buyback at rupees 30. So for one share, how much we are paying? We are paying 30 rupees. So here, write down 25. First of all, how much is the maximum it is allowed? 25% of it. So first calculate here 25% of rupees 2,880. That is 720. 720. That is 720. So maximum amount that we can utilize for the purpose of buyback is how much? 720. So maximum amount that we can utilize for the purpose of buyback is how much? 720. So write down here maximum number of shares. Maximum number of shares. 720 is the maximum amount that we can utilize for the purpose of buyback as per resource test. For one share, we are paying how much? Rupees 30 we are paying for one share. So 720 divided by 30. The 24 crores. All figures are here in crore. So the shares are also in crores. So 24 crores shares. 24 crore shares. 24 crore shares. Okay, 24 crore shares. So as per first test, that is resource test, how much we are getting? We are getting 24 crore shares. That maximum we can do buyback. Now after this, second. After this, write down there. Okay, write down there. Share outstanding. Share outstanding test. Situation 1. Situation 1. Situation 2. Okay, situation 1 and situation 2. So here number of outstanding share, number of outstanding shares. Okay, number of outstanding share. How much is the number of outstanding share? Amount is 1200 and share is of rupees 10 each. So current outstanding is how much? 120. So 120 crore shares. 120 crore shares. 120 crore shares. Okay, 120 crore shares. Okay. Then here maximum is allowed 25% of outstanding shares. So here 25% of shares outstanding. Shares outstanding. Share outstanding. Okay. So here 120 crore shares multiply by 25%. So 120 multiplied by 25, that's come 30 crore shares. So as per these conditions, share outstanding test, the maximum number of shares that we can do buyback is 30 crore shares. 30 crore shares. 30 crore shares. Okay. So as per first condition, the maximum is how much? How much maximum? Is 24 crore shares. And as per this condition, 30 crore shares. Okay. So now third is debt equity ratio test. Write on third point, debt equity ratio test. Debt equity ratio test. Debt equity ratio test. So here, as per third condition, debt amount be in excess, just one, debt, or you can say debt cannot be in excess of twice the paid up capital, and free reserve, twice the paid up capital and free reserve. So situation 1, we have already solved this type of question. Okay, situation 1, situation 2, and I hope you are doing homework. Homework is very important. Okay, you have to do homework daily. Write down there now. Is first is loan funds. What is loan fund? That is debt. The first point is loan funds. It is given in question 3,200 in situation 1 and in situation 2 6,000. Second point here, minimum paid up capital, and free reserve to maintained, this one, okay, free reserve to be maintained after buyback. We have already discussed about this point earlier also. So how much minimum paid up capital and free reserve to be maintained? That is 50% of debt. So here 50% of loan funds. I'm writing in bracket 50% of loan funds. Okay. So in first case 3,200 multiply by 50%. 6,000 multiply by 50%. So how much it is? 1,600, and how much it is? 3,000. Now here, third point, present paid up capital and free reserve. How much present paid up capital and free reserve? That we have calculated in first point here, which is here 2,880 under both the situation. So write down here 2,880. Now understand this point. What happened here? Here this much should be maintained. So first I am discussing about situation 1. Now understand this point. Okay, just give me a minute. Okay, situation 1. Here if you see in situation 1, how much paid up capital and free, I'm talking about first situation 1. Okay, let me write here. Situation 1. Okay. So whenever I use any color other than blue color, that is for your reference. Okay. No need to write in examination please. So how much existing paid up capital and free reserve is 2,880. So existing paid up capital is 2,880. This is existing. And some amount will be transferred to CRR, we call it X, and then some should be maintained. And how much should be maintained? 1,600, and remaining can be utilized for the purpose of buyback, that is Y. So what is this 2,880? This is existing paid up capital and free reserve. This much will be transferred to CRR. This is existing paid up capital plus free reserve. And X is the amount of that we have to transfer to CRR. Some will, out of this, some will be transferred to CRR and some amount should be maintained. It should be maintained. Okay, maintain paid up capital and free reserve, and this is permitted amount. This is permitted amount for the purpose of buyback. Permitted amount for the purpose of buyback. So we have to calculate it by simultaneous equation. We will do it for situation 1. But what about the situation 2? What about the situation 2? Understand this point. If you see here, how much is existing paid up capital and free reserve? So existing paid up capital and free reserve in situation 1, existing paid up capital and free reserve in situation 2. So existing is how much? Existing paid up capital and free reserve is 2880. And how much minimum they should maintain? The minimum that they should maintain is how much? How much it is? 3000. So their paid up capital and free reserve is already below the existing below the amount they should maintain. The amount that they should maintain in the form of paid up capital and free reserve is 3000. They should maintain minimum, and already existing paid up capital and free reserve which is lower than 3000. So 3000 they should maintain, and their existing is 2880. It means they cannot do buyback here. Why? How much they should maintain? 3000. So it is already below the 3000 existing paid up capital and free reserve. So they cannot do buyback here. That's why permitted amount here is how much? 0. What does it mean? What does it mean? If it is permitted amount is 0, it means they cannot do buyback here under situation 2, because there is a here debt equity ratio says that the maximum number of shares that they can do buyback is 0. Why 0? Because their existing paid up capital which is lower than the minimum that they should maintain. So they have to maintain 3000, and their existing is 2880, which is lower than the minimum they should maintain. Therefore they cannot do buyback. So here we have to solve by simultaneous equation this under situation 1. So here this is just for your reference. Okay, point number 3. Now write down here point number 4. Point number 4. Write down here point number 4 now. Maximum permitted amount. Maximum permitted amount or maximum, right? Maximum permitted buyback, or buyback, maximum permitted buyback. Okay, how much it is? We will calculate in working note number 1. We'll calculate in working note number. We have to solve it by simultaneous equation. Now after that, point number 5 will come. Here it will be 0, and in situation 2 it will be 0. For situation 1 we have to calculate. Then here maximum number of shares that can be bought back at the rate of rupees 30. We are doing buyback at rupees 30, at the rate of rupees 30 per share. So we'll calculate it, but first we have to calculate the maximum permitted amount. Maximum permitted amount means this y, because x is this is the amount, this is the existing, and x will be transferred to CRR. This much should be maintained, and remaining is permitted amount. So we will calculate y so that we can find it out this figure permitted amount, and for one share we are paying 30, so we will divide it by 30. The maximum number of share will come here. Okay, but under situation 2 it is not allowed. Okay, nil. So write down here after this 5th point, keep the space for 3-4 lines, and then write down working note. Okay, working note. Write down here working note number 1. Amount transferred to CRR and maximum equity to be bought back will be calculated by simultaneous equation. method, simultaneous equation method. Okay, suppose amount transferred to CRR is X and maximum permitted is Y. Then first point here, rupees 2,880 is the present paid up capital and free sum. Out of this sum will transfer to CRR, that is X. Okay, and amount that should be maintained 1,600, remaining can be utilized. Second equation, Y is the maximum permitted amount divided by rupees 30 you are paying for one share. So Y is the maximum permitted amount. If you divide it by rupees 30 that you are paying for one share, so number of share will come, and when you will multiply by rupees 10, that is face value. What is this 10? This is face value. What is this 30? This is buyback price. Okay, buyback price. What is this Y? This is permitted amount, maximum permitted amount. Okay, maximum permitted amount. Okay, so Y divided by 30 multiply by 10. So how much here? That will come X. What is this X? If you permitted amount divided by 30, for one share you are paying 30. So number of shares come that you are doing buyback. When you multiply by rupees 10, that is face value. So that we transfer to CRR. That's why equals to X. Or can I write it as 3X equals to Y? By solving the above equation, we get what we get, X equals to and Y equal to. Calculate this here, write it down in place of Y, 3X. So 3X, it will come 4X. So 2880 minus 1600 divided by 4, that's come 320. So 320 that will transfer to CRR, and we know X now. So 2880 minus 320 minus 1600, that's come 960. So 960 the maximum permitted amount. Write down there 960. Okay, write down there 960. Okay, now we have calculated the maximum permitted amount. So here write down working unit number that we have calculated, 960. For one share we are paying 30 rupees. So 960 divided by 30. So how many shares? Divided by 30. It's come 32 crore shares. So 32 crore shares. So as per this third test, the maximum number of share that we can do buyback is 32 crore share, and for this situation to 0. So we cannot do buyback under situation 2 because the maximum that we can do is the least of these three, and here it is 0 na. So we cannot do buyback under situation 2. The good news is that we have to just pass journal entry for situation 1 only, because we cannot do a buyback under situation 2. So write down here maximum number of shares that can be bought back least of the above. In situation 1, 24 crores shares, and situation 2 is 0. Okay, situation 2 is 0. Then so now we have to pass journal entry. So how many maximum number show that we can do buybacks? 24 crore. How I have calculated 24? This is 32, 24 and 30. Least is 24. Okay, that's why. Now we have to pass journal entry. Very simple now. So give the heading now. Journal entries. Okay, I'm writing in next page. Okay, I'm writing in next page. Okay. Journal entries. journal entries in the books of SMM Limited, and in bracket write down situation 1, and here rupees in crores, okay. Now draw this for half page, because just 4 entry we have to pass. They are not issuing any shares in the market, they are doing out of profit. If nothing is mentioned, we will say it is out of profit. To draw this for half page, okay, one by one now. So here first we will purchase shares. So entry will be equity share buyback account debit, 24 crores shares multiply by rupees 30. So 24 crore shares, and for one share we are paying 30. So how much it is? 720. Okay, 720 to bank account, 720 being payment on buyback of shares. The next point now, here we have to cancel it now. What is the face value of share? Rupees 10. We are paying how much? 30. So 20 rupees represent premium on buyback. So write down here equity share capital account debit, 24 crore shares. For one share face value is rupees 10. So 24 multiplied by 10, that's come 240. Then premium on buyback account debit, 24 crore shares multiply by rupees 20. So it will come 480 to equity share buyback account, that is 720, being cancellation of equity share on buyback, okay. Now what we have to cancel this premium on buyback. How much it is? 480. But whether we have balance of 480 in securities premium? No. How much we have? We have 400. So we will utilize 400 out of the securities premium, and remaining 80 we can utilize from general reserve or from P&L account, whatever. So write down here securities premium account debit. For premium on buyback, we can utilize securities premium also. Okay. For premium on redemption of preference share also we can utilize, but there is one condition that securities premium cannot be utilized by the company who is following accounting standard. So generally companies follow accounting standard. So we avoid to utilize securities premium to write off premium on redemption of preference share. That's why. Okay. Anyways, so but premium on buyback, no problem. Securities premium account debit. Securities premium account debit. How much balance we have? 400. General reserve account debit. General reserve account debit, that is balance amount. Total is 480, and 400 out of securities premium, it is 80 out of general reserve. To premium on buyback account. It is 480. Now being premium on buyback adjusted against securities premium account and general reserve Okay, now after this we have to transfer to CRR account the face value of buyback, that is how much? 240. So whether we have balance, we have enough balance in general reserve, so we'll utilize general reserve. So next entry, general reserve account debit, general reserve account debit 240 to capital redemption reserve account 240, being face value of equity shares buyback transferred to CRR account as per law. Okay, done. So the question number 7 is done. Now today I will give you homework, all the remaining, because the chapter will be finished today. So here question number 8 and 9 we will solve, but for the whole, and we have MCQs we will discuss. But here question number 1 done, second also homework I am saying done, third done, fourth done. Today homework will be fifth. Fifth I think simple it is, but today homework will be fifth. So question number 5th will be homework. And question number 5th will be homework, and question of 6th, 6th I have not given 6th also. Oh, so 5th, 6th, just give me a minute. 5th, 6th, I have not given 6th though. Just give me a minute. I think I have given 6th. In previous lecture I gave you 2nd and 4th. Okay, 2nd and 4th. Anyways, remaining will be homework now. 3rd and 7th is not given. Okay, no problem. So here 5th, 6th and 5th, 6th and 8th will be homework. 3. Okay. So here when you will solve 8, question number 8 I am discussing here. Remember that here when you will solve it, same, there are two situations is given, same. It is similar to question number that we have solved just now. I think question number 7. Similar to question number 7. Okay. But remember one thing. Here this is situation 1, this is situation 2. Situation 1 and situation 2. How much it just no, this is only one situation. Okay. But there are other situations also. This situation 1. Wait here. But what happened here? It is mentioned that the shareholder of a parity limited on the recommendation of board of directors have approved on 12th of September a proposal to buy back maximum permissible number of equity shares considering the large surplus fund available at the disposal of the company. It means they are doing buyback out of profit. So we will transfer to CRR. Okay. The prevailing market value of the company's share is rupees 25 per share. In order to induce the existing shareholder to offer their share offer their shares for buyback, it decided to offer a 20% over market price. Now understand this point. 20% over market price. So market price is rupees 25 plus 20%. How much it is 25 plus 20%? That's come rupees 30. So we are doing buyback at 30 and the face value is 10. We are doing buyback at 30. So premium, don't tell me that premium is rupees 5. No. This is the market value, beta. This is market value. 25 rupees is market value, beta. And we are doing buyback 20% more than the market price. So that is 25 rupees plus 20%, that's come 30 rupees. This is buyback price and you are doing buyback, this is buyback price and the face value is rupees 10. It means you are paying additional 20 rupees. So that is premium on buyback. So premium, this is face value 10 and premium on buyback will be rupees 20 and buyback price will be 30. Remember, okay. Now you are informed that the infrastructure development reserve is created to satisfy income tax requirement. As I told you that there are certain reserves which we have to maintain as per law. So they are saying that this is statutory reserve, and the reason is also mentioned here that it it is, we have maintained this reserve due to what? To satisfy Income Tax Act requirement. Okay, this is not a free reserve. Okay, this is free reserve, these three. Okay, now here you are required to compute the maximum number of shares that can be bought back in the light of the above information. Also, under a situation where the loan fund of the company were either rupees 1200 and 1500. It means there are three situations here. This situation 1, situation 2 and situation 3. So here this loan fund is 1800 and they are saying here 1200 and 1500. Situation 2, 1200 and 1500. So you have to solve same in the same fashion that we have solved this question number 7. But here there are two situations, situation 1 and situation 2. Here there are three situations, situation 1, 2 and 3. So all figures are same except in case of loan fund, in situation 1 1800, in situation 2 1200, in situation 3 1500. It is very important question. Okay, so this homework question number 8, which is similar to question number 7. And here today's I think question number 5th and 6th I have given. Okay, 5th and 6th, 5th, 6th and 8. Okay, 5th, 6th and 8. Okay, so come here. Now we will solve question number 8. Today's homework is, let me write here, 5th, 6th and 8. Okay, okay. Now come to question number 8. Now what happened after every chapter? After every chapter, I will tell you some important question that you have to solve at the time of revision. What happened? It is very important. You attend the regular class. You will do the homework, but it is very important before the examination how to do the revision, which is very important. Okay. So in every chapter, what I will give you some question. Here in class question we have total 9 and I think 8 question in homework. So 9 plus 8, that's come 17. No need to solve 17 at first time in regular batch. You have to solve with me. You have to do the homework. You have no other option. But when you will do revision, you have no time to solve the 17 question. So out of 70, I will give you 7, 8 question, 50% question. 40 to 50% question I will give you, that only those questions you have to do practice at the time of revision. That's it. Okay, out of 17 I will give you 7, 8 questions. So at the time of revision you just have to do only 7 and 8, those 7 and 8 questions. Okay. Now I call it LMM. What is LMM? Last minute mastery. In last minute you just have to cover those questions. Okay, so at the time of revision. Now I will tell you at the end of the chapter. Okay, now come to question number 8. Come to question number 8. Umesh Limited resolved to buy back 4 lakh of its fully paid equity share of rupees 10 each at rupees 22. What is the face value of share? Face value of share is rupees 10 per share. And how much we are paying? We are paying 22. It means 12 rupees represent premium on buyback. 12 rupees represent premium on buyback. Now after that, this buyback is in compliance with the provision of the Companies Act and does not exceed 25% of the company's paid up capital in the financial year. For the purpose, it issued 1 lakh 11% preferential of rupees 10 each at par. It means they are issuing some shares in the market. So you know that buyback can be out of profit, it can be out of fresh issue of shares, and it can be a combination of both. So we will see here, I think it will be a combination of both here, because they are issuing some share, but they are issuing only 1 lakh share. 1 lakh multiplied by 10, that will come 10 lakh rupees. So capital will be increased by rupees 10 lakh when you issue the share. But what happened? You are doing buyback here. How many number of shares you are doing buyback? 4 lakhs. Na? So how much decrease in capital? 4 lakh multiplied by face value. That's come 10. So 4 multiplied by 10. That's come 40 lakhs. 40 lakhs. So capital will be reduced by rupees 40 lakh. But you are issuing shares in the market of 1 lakh. 1 lakh shares. So the capital will be increased by 10 lakh. So when you do the buyback, capital will be decreased, and when you issue the share, the capital will be increased. So at the time of buyback here in question, we are doing buyback of 4 lakh shares. So 4 lakh multiplied by 10, that's come 40 lakh. And what we are doing, at the time of buyback, capital will reduce by rupees 40 lakh. But we are issuing fresh issue of shares in the market, 1 lakh share of rupees 10 each. So 1 lakh multiplied by 10, that's come how much? 10 lakh. So capital will increase by 10 lakh, but it will reduce by 40 lakh. Okay. At the time of buyback, reduce 40. Issue of share increase 10. So how much will be the difference? 30 lakh. It means that 30 lakh is out of profit. So we have to transfer to CRR account that 30 lakh. So how any buyback that we are doing out of profit, that much we have to transfer to CRR account. I will make a working note on it. Okay. Now Now the entire amount being payable with application, the company uses rupees 16 lakh of its balance in securities premium account apart from its adequate balance in general reserve to fulfill the legal requirement regarding buyback. What happened here? It is mentioned in the question that the company will utilize 16 lakh of its securities premium account. So we will utilize 16 lakh of securities premium account, only 16 lakh. Any amount which is required more than 16 lakh, for that we will utilize what? General reserve. So for 16 lakhs we will utilize securities premium, and any additional amount we will utilize general reserve for it. Now give necessary journal entries to record the above transaction. So very simple question. Now give the heading here, question number 8. Question number 8, page number 12. So here write down journal entries in the books of Umesh Limited. Okay, write down first we will pass entry of issue of shares. So give the heading here, issue of preference share. We are issuing preference share. Issue of preference shares. So write down here, first entry. When we issue, we receive amount. So bank account debit, 1 lakh shares we have issued in mark, 1 lakh shares at the rate of rupees 10. So multiply by 10, so that's come 10 lakh. 10 lakh. Okay. To 11% preference share application account, preference shares application and allotment account that we are receiving at the time of application and allotment, that is 10 lakh. 10 lakh. Okay, because it is mentioned in question that entire amount being receivable with application. So we will say here application and then we will cancel it. Issue of shares entry. Okay. So being entire amount received on application. Entire amount received on application. How much? 10 lakh. Now this application balance will transfer to share capital. Effect will be same. I mean to say effect will be bank account debit to share capital account. That we have received the amount and share capital increases. But first we have credited because we have received this amount at the time of application, and then now we transfer the balance of application to share capital account. So we have credited here this application account. Now we will debit it. So net effect will be bank account debit to preference share capital account. Pass next entry. Okay, draw this for one page. Okay. Okay, write down here now next entry. Okay, second 11%, name I think 11% on here. Yes, 11% preference share capital account, not capital, sorry, 11% preference share application and allotment account. Just write down, I will explain you, don't worry. Allotment account debit 10 lakhs to 11% preference share capital account 10 lakh, being 1 lakh 11% preference shares allotted at par. Now understand this point. Here you have credited is 11% preference share application account and you have debited here. So that account gets cancelled. So what is the net effect here? Here you have debited to this bank account. So bank account debited to 11% preferential capital account. So bank account debited to 11% preferential capital account. Okay. Now third entry. Now we'll do entry for buyback now. So you can give the heading here, buyback of shares. Now we are doing buyback of equity shares. So third entry here. So how many shares we are doing buyback? 4 lakh. We are paying 22 rupees for one share. So first we'll purchase shares. So buyback, equity buyback account, equity share, buyback account debit, 4 lakh shares multiply by rupees 22. So 4 lakh multiplied by 22, that's come 88 lakhs to bank account. 88 lakhs to bank account, 88 lakhs. Okay. Being payment made for buyback. Being payment made for buyback. Now we have to cancel share. So decrease in capital, debit. Same entry offer, same for this buyback. Now equity share capital account debit. Equity share capital account debit. 4 lakhs shares. What is the face value of share? Rupees 10. 40 lakhs. Then premium on buyback. Premium on buyback account debit. 4 lakh shares. For one share, how much premium you are paying? 12. We are doing buyback at rupees 22 beta. And what is the face value of share? 10. So additional 12 rupees we are paying. That is premium on buyback. So this 4 lakh multiplied by 12, 48 lakhs. 48 lakhs. To equity share buyback account. To equity share buyback account. That is 40 lakhs plus 48 lakhs. It is how much it is? 88 lakhs. Being cancellation of equity share being cancellation of equity shares on buyback. Now how much premium on buyback that we have paid? We have premium on buyback is 48 crore. So we can write it off against securities premium, but it's specifically mentioned in question that the maximum that we can utilize is how much? 16 lakhs. What about the remaining? For remaining we will utilize general reserve. It is mentioned that they have adequate balance in general reserve. So first we will utilize securities premium. Now some student asks, sir, should we utilize 16 lakhs of securities premium? Yes, because it is specifically mentioned that they have balance of 16 lakh. It means indirectly it is mentioned in question that you have to utilize that 16 lakh. And then we will utilize general reserve. So first here, securities premium account debit. Securities premium account debit. 16 lakh. General reserve account debit. General reserve account debit. So 48 lakhs requires. We have adjusted 16 lakhs out of securities premium. So 48 minus 16, 32 lakhs will be out of general reserve. To premium on buyback account. How much? 48 lakhs. Being premium on buyback adjusted against securities premium and general reserve. Okay. So now here, last entry. You see what last entry? We have to transfer to CRR. Now you say, no, sir. We have done the buyback out of fresh issue of shares. Listen here. How much is the amount of capital that we have increased? The amount of capital here, the amount of capital on issue of shares, the capital is increased by rupees 10 lakh. Agree? The preference share capital increased by rupees 10 lakh. At the time of buyback, you have debited to share equity share capital account. So capital is decreased by 40 lakhs and it is increased by 10 lakh. What about the remaining? What about the remaining 30 lakh? The replacement of capital should be capital. But here capital is replacing only by 10 lakh. What about the 30 lakh? That means that 30 lakh is out of profit. So we have to transfer 30 lakh to CRR account. Okay. We'll make a working note on it. So right, it is a combination of both. We are doing buyback out of profit and out of fresh issue of shares. So write down there. Write down here. Write down here. General reserve account debit. General reserve account debit. Working note number 1 we will calculate it. General reserve account debit 30 lakhs. But you know how we have calculated 30 lakhs. We will make a working note on it. To capital redemption. To capital redemption. To capital redemption. Reserve account 30 lakhs. Being face value of buyback of shares out of profit transferred to CRR account as per law. Now write down there working note number 1. Working note number 1. Working note number 1. Amount to be transferred to CRR. To CRR, capital redemption reserve. Okay. Write down here face value of shares buyback. Remember one thing, capital always be increased and decreased by face value only. Okay, because we record capital at face value only. That's why here face value shares buyback is 4 lakh shares multiply by rupees 10, 40 lakhs less face value of preference shares issued for buyback 1 lakh shares multiply by rupees 10, because we are doing we are issuing at 1 lakh share at rupees 10. Okay, this is we have to take face value. Even it is issued at premium, so we have to take face value because capital increase or decrease by face value only, because we record capital at face value. So here it will come 10 lakh. So here it is how much? 30 lakhs. Out of profit 30 lakhs. Out of profit how much? 30 lakhs. Okay. Only one question left, that is question number 9, and it's very important question, I will take a break for 10 minutes. So actually no need to take a break today. One question only left, because daily we record in part 1 and part 2. That's why I'm making 2 part here. So it's okay. You can take a break for 10 minutes or you can start immediately. So here the end of part 1. In part 2 we will do question number 9. Okay.